Few books have stood the test of time like Philip Fisher's Common Stocks and Uncommon Profits. Published in 1958, it remains a beacon for long-term investors. Fisher's approach emphasizes qualitative factors and in-depth research. It's not about quick gains. He teaches us to look beyond the numbers, finding companies with real growth potential, identifying diamonds in the rough, and holding them for the long haul. It's a philosophy, a roadmap for navigating the stock market. Common Stocks and Uncommon Profits, published in 1958, quickly became a Wall Street classic. It wasn't just another investment book. Fisher's focus on long-term growth investing struck a chord with many. His emphasis on qualitative factors such as management quality and competitive advantage was revolutionary. It helped to shape the way we think about investing. Warren Buffett credits Fisher as a major influence. Common Stocks and Uncommon Profits remains a must-read for any serious investor. At the heart of Fisher's investment philosophy lies the scuttlebutt method. This method emphasizes gathering information from a variety of sources. It's about going beyond the numbers. Talk to customers, talk to competitors, talk to suppliers. Get the real story about a company. Fisher also developed a set of 15 points to consider when evaluating a company. These points cover a wide range of factors. They include management integrity, research and development, and sales organization. Each point provides valuable insight into a company's potential for long-term growth. Fisher believed in investing in companies with a durable competitive advantage. He looked for companies with strong management teams. He wanted to see a commitment to innovation. These factors, he argued, were essential for achieving sustainable growth. The scuttlebutt method and the 15 points provide a framework for identifying promising investment opportunities. They encourage investors to look beyond the surface. They emphasize the importance of understanding the qualitative aspects of a business. This approach is crucial for uncovering hidden gems in the market. Fisher was a staunch advocate of long-term investing. He believed that short-term trading was speculation, not investing. True investing, he argued, required patience and conviction. It meant holding onto your stocks for the long haul. Fisher understood that businesses take time to grow. He knew that even the best companies face challenges. He believed that investors who panicked and sold at the first sign of trouble would miss out on significant gains. Instead, Fisher urged investors to focus on the bigger picture. He wanted them to believe in the companies they invested in. He encouraged them to ride out the inevitable ups and downs of the market. This long-term perspective is perhaps the most important lesson we can learn from Fisher. It's a reminder that investing is a marathon, not a sprint. It requires patience, discipline, and a belief in the power of compounding. Section 5. Investing in quality management, growth, and competitive advantages. Fisher believed in investing in quality companies. Quality meant exceptional management, consistent growth, and a sustainable competitive advantage. Management was the backbone. Honest, capable leaders were key. Growth was non-negotiable. A clear path for future expansion was crucial. A unique edge over rivals ensured long-term success. Section 6. Practical applications, Fisher's wisdom for today's investor. While Common Stocks and Uncommon Profits was written decades ago, its wisdom remains strikingly relevant. Fisher's principles provide a timeless framework for investors seeking to navigate today's complex and fast-paced markets. One of the most valuable takeaways from Fisher's work is the importance of thorough research. Don't just rely on headlines or analyst reports. Dig deeper. Understand the businesses you're investing in. Use Fisher's scuttlebutt method. Talk to customers, competitors, and employees. Get a 360-degree view of the company. Another key takeaway is the importance of focusing on the long term. Tune out the noise of the market. Don't get caught up in short-term fluctuations. Remember that investing is a marathon, not a sprint. Be patient. Be disciplined. Your future self will thank you. Finally, never underestimate the power of conviction. Once you've done your research and identified promising companies, have the courage to invest in them and hold on to them. Believe in your analysis. Trust your instincts. Section 7. The importance of thorough research, beyond the balance sheet. In today's data-driven world, it's tempting to rely solely on readily available financial information. However, Fisher urges us to look beyond the balance sheets and income statements. He stresses the importance of delving deeper into the qualitative aspects of a business, understanding its culture, its competitive landscape, and its future potential. Fisher's scuttlebutt method is more relevant than ever. Talk to people within the industry. Interview customers, suppliers, and even competitors. Gather insights into the company's operations, its management team, and its overall reputation. This first-hand information can be invaluable in forming a well-rounded investment thesis. Remember, numbers tell a story, but they don't tell the whole story. By engaging in thorough research, by going beyond the readily available data, you gain a competitive edge. You're able to identify hidden gems that others may overlook. Section 8. Diversification and Risk Management: A Balanced Approach. While Fisher championed the idea of concentrated investing, believing that true wealth was built by owning a few outstanding companies, he also recognized the importance of diversification as a risk management tool. Diversifying your portfolio across different sectors and industries can help mitigate losses. It can provide a buffer against unforeseen circumstances that may impact a particular sector. However, Fisher cautioned against over-diversification. Owning too many stocks can dilute your returns and make it challenging to track each company effectively. The key is to strike a balance. Identify a manageable number of high-conviction investments, companies that meet your criteria for quality, growth, and competitive advantage. This approach allows you to benefit from concentrated bets while mitigating risk through sensible diversification. Section 9. Fisher's Enduring Impact: A Legacy of Growth and Value Investing. Philip Fisher's legacy extends far beyond the pages of his book. His ideas have shaped the investment landscape, influencing generations of investors and inspiring countless success stories. His emphasis on long-term investing, in-depth research, and identifying companies with a durable competitive advantage remains as relevant today as it was decades ago. Many see Fisher as a pioneer of growth investing. His focus on identifying companies with exceptional potential, those capable of compounding returns over time, laid the groundwork for this widely popular investment style. However, he was also a proponent of value investing, believing that investors should seek out companies trading below their intrinsic worth. In many ways, Fisher bridged the gap between growth and value investing. He emphasized the importance of both qualitative and quantitative factors, arguing that successful investing required a holistic understanding of a business. Section 10. Conclusion: Embracing Fisher's Principles for Investment Success. In the ever-changing world of finance, some principles remain timeless. Philip Fisher's Common Stocks and Uncommon Profits encapsulates these enduring truths. His emphasis on in-depth research, long-term investing, and identifying companies with a sustainable competitive advantage continues to resonate with investors seeking to build lasting wealth. The beauty of Fisher's work lies in its accessibility. His teachings are not reserved for Wall Street veterans. They are applicable to anyone willing to put in the time and effort to understand them. Whether you're a seasoned investor or just starting, Fisher's wisdom can provide a roadmap for navigating the complexities of the market. As you embark on your investment journey, remember the key takeaways from Common Stocks and Uncommon Profits. Do your homework, be patient, invest with conviction, and above all, embrace the long-term perspective. The path to uncommon profits is paved with diligence, discipline, and a belief in the power of compounding.